Happy Monday, everybody. I hope you had a great weekend. Lots happened last week, plenty to talk about today, including market moves driven by geopolitics, earnings, and economic data. Let's also preview the week ahead. It's shaping up to be just as busy. Inflation watch, jobs watch, Fed watch, geopolitics, oil, gold, all of these factors should continue to drive the markets this week. Today is October 14th, 2024, and this is your Monday, Columbus Day market update. Let's start with a recap of last week. It was a rough start for the market, driven by escalating geopolitical tensions in the Middle East. Conflict between Israel and Iran was front and center, marking the one-year anniversary of the initial attacks on Israel. This, combined with the concerns about rising treasury yields, pressured stocks. Hawkish U.S. economic data, including stronger than expected ISM services and a much hotter than expected September's jobs report. They did fuel fears that the Fed will keep rates higher for longer, and to that, disappointing German manufacturing data, and that cast a shadow over Europe, hitting global sentiment. Oil prices spiked, with WTI crude oil climbing another 4% to over $77 a barrel on geopolitical fears, of course, while gold fell a third of 1%, weighed down by a stronger U.S. dollar and higher yields. The Dow and the S&P both closed down about 1%. The NASDAQ dropped almost 1.25%. Tuesday saw a reversal as markets rebounded, led by tech stocks and stabilizing yields. The market responded positively to comments from Fed head Kugler, who reassured investors that the Fed is still on track for that soft landing. His dovish tone sparked a rally, particularly in tech. China was a drag on the global front, with Chinese equities falling more than 9% due to disappointing stimulus efforts. Still, U.S. markets shook off those worries as investors focused on domestic issues, and a brief drop in oil prices fueled by hopes of Middle East ceasefire talks. Oil reacted to that and fell over 4%. Gold was down another 1% also. Despite some volatility caused by the geopolitical risks, markets recovered by the end of the day. The Dow inched up about 1/3 of 1%. S&P rose almost 1%, and the NASDAQ climbed 1.5%. Wednesday was another strong day. Support came from central bank actions around the globe, including a 50 basis point rate cut by the Reserve Bank of New Zealand. Yes, we've gone around the world searching for good central bank news. We've been to the other countries, but this is the first mention of the Bank of New Zealand, but markets grabbed hold of that anyway, so here we go. Investors were also encouraged by news that the Chinese government would announce further stimulus measures. So bond markets did stabilize. The release of the Fed minutes from last month's meeting did reaffirm expectations for 2 or more rate cuts this year, providing additional support for the equity markets. Oil prices fell slightly as supply-demand concerns began to overshadow those geopolitical risks. Gold also fell a little bit as well. Dow closed up 0.5%. S&P rose about 0.75%. The NASDAQ gained 2/3 of 1%. Thursday saw a slight pullback in the markets as investors reacted to mixed economic data. The September CPI report showed a smaller than expected drop in headline inflation at 2.4% versus a 2.3% expected, while core inflation edged higher to 3.3%, sparking concerns about persistent inflation pressures. I say again, I do not see this as anything but grasping at straws. I maintain that the risks are once again valuation or continued growth, geopolitics, and politics. Jobs will get a read on that. Earnings will get a read on that. Inflation will be a data point. But unless we see something big, I'm not worried about that. The other three, maybe a bit worried, but not that. Jobless claims did jump by 35,000 to 258,000, but analysts attribute this to temporary factors like the Boeing strike and Hurricane Helene. Markets also reacted to Fed head comments from Atlanta Fed President Bostic, who indicated a potential pause in rate cuts may be the right thing to do. Not something the Fed usually does after just one cut, but we'll see how that goes. By the end of the day, the Dow fell about 0.25%. S&P 500 slipped 0.25%. The NASDAQ down just slightly. Friday was a strong finish to the week, driven by better than expected third quarter earnings from major banks like JP Morgan and Wells Fargo. JP Morgan rose 4.4% on strong revenues, while Wells Fargo jumped 5.5% despite a slight drop in profits. Investors did take this as a positive signal for the economy and, of course, the banking sector. PPI was under or in line with expectations, so nothing to see here. Markets did get a chance to react to the Tesla robo-taxi. Markets were not impressed, taking that stock down. University of Michigan survey had a bit lower consumer confidence and stable inflation outlooks on year one, on 1 and 3 years. By midday, if you're looking for more than just mega techs, 55 stocks in the S&P 500 were trading at new 52-week highs during Friday's session. Of those, 32 of them hit new all-time highs. In the S&P, 4 out of 5 stocks were higher. We're tracking to end Friday, at least, in the green. And of course, that's broadening out. The S&P 500 rose about 0.5% to a new historic high of 58.15. So let's see what did all these markets do. The Dow closed up 1%, also a new high. S&P, as I said, closed almost up 2/3 of 1% to close their new high, and the Nasdaq added about a third of 1%, about 2% below the old high. For the week, the Dow was up about 1.25%, the S&P 500, and the Nasdaq jumped over 1%. That's on the week. Let's look ahead into this coming week. Bond markets are closed today for Columbus Day, but stock markets are open. So let's see what we've got going ahead of us. This week is packed with market events to watch. Earnings season continues. So we'll hear from a few more of those major financial firms: Goldman, Morgan Stanley, Citigroup, PNC, and State Street. We'll also hear from some of the others: United Health Group, Johnson & Johnson, Taiwan Semiconductor, and Netflix. I continue to think that these reports and the ones like them, those are the key to the market. We do have inflation risk and Fed risk, but I think growth is our biggest risk. We have lost growth momentum, but as long as we don't stall out, we should be okay. And these reports will help us watch for that. We'll also get some eco data, retail sales data. Again, this will help us see the strength of that consumer, about 70% of our economy, which will show whether consumers are still spending despite inflation pressures. Housing market data like housing starts, building permits, and the Home Builders Confidence Index, which will offer some insight into the strength of the housing sector as mortgage rates show some declining. We'll also get some of that high frequency labor market data and the jobless claims. Fed heads, we'll get them again as well. We'll have Waller, Kashkari, Daly, and Kugler, actually a pretty light week. Their comments will give us more clues about the Fed's next moves as we approach the November meeting. As always, remember, stay focused on your long-term goals. Markets may be volatile in the short term, but if you have a long-term horizon, stay the course and don't let that day-to-day noise affect your strategy. Remember, stay focused on our goals. That's what we do. Certainly watch for that on our Friday videos. Have a great week ahead. We'll see you then.